So I posted this inside the private stock group, and I thought this was a really important message here. I said, when you see something like this, the stock market gets a lot less scary, doesn't it? We are looking at the biggest drawdowns in a year versus the total returns by the end of the year. And wait till you see these numbers here. I said, look back at the end of the world great financial crisis. You hear about that. Oh my gosh, the biggest crash we had in the last 20, 30, 40, 50 years, right? Oh my gosh, the whole banking system nearly collapsed, right? 2007 had a total return up 5%. 2008 had total returns down 37%. 2009 had total returns up 26%. That's your big bad Michael Myers? That's your Freddy Krueger? Like literally, you think about the last many, many decades in the stock market. This is the big one, right? Where all the indexes went down 50%, peak to trough. And at the end of the day, 2007 was positive, and 2009 was a banger year in the market. You had one bad year, and that was '08, right? 1987, the oh my gosh, collapse of the stock market, the biggest one-day drop in history, happened in 1987. Total returns by the end of 1987 were up 5%. Oh my gosh, the whole world is over in 2020. The fastest stock market crash in history. By the end of 2020, total returns were up 18%. The stock market is not scary. The people in the stock market are scary. The people telling you stories are scary. The opinions are scary. The facts are not scary when you really look at them. Save this image in your phone to use during future crashes and corrections in the market. Okay? So, if we look at my entire life, no, I'm not talking just my investing life, which started in '08, '09. I'm talking my entire life, right? Start back here in 1989. The market fell the most, 7.6% that year. Total returns by year end were 31%. 1990, 20% drawdown. By the end of the year, total returns were only negative 3%. 1991, 5.7% down drawdown. By the end of the year, total returns were up 30%. 1992, 6%. Oh, that's down. Guess what? You finish the year up 7%. 1993, down 5% drawdown. By the end of the year, you're up 10%. 1994, down 9%. By the end of the year, up 1%. 1995, down 2.5%. By the end of the year, up 37%. 1996, down 7%. By the end of the year, up 23%. 1997, down about 11%. By the end of the year, up 33%. 1998, down 19%. By the end of the year, up 28%. 1999, down 12%. And by the end of the year, you're up 21%. Then we went through the tech bubble, right? Tech valuations got to just silly prices. The PE ratios were ridiculous. Companies were unprofitable. It was the messiest time we really had seen in the stock market. And you can't even compare it to any other time period because we haven't had another time period where you just had a ridiculous amount of unprofitable companies out there that were massive market caps, insane PE ratios on stocks. Like if you look at like all the big tech companies today, they all trade at very fair or undervalued PEs today. So you can't really equate this time period to any other time. But then you had 2000, we were down 17% drawdown, finished the year down 9%. 29%, almost 30% drawdown in '01. By the end of the year, finished down 11%. 2002, almost 34% drawdown. By the end of the year, 22% drawdown. 2003, 14% drawdown, up 28% by the end of the year. 2004, down 8%. By the end of the year, up 11%. 2005, down 7%. By the end of the year, up 5%. 2006, down 7.7%. By the end of the year, up 15.8%. Now we're almost getting to my investing lifetime, okay? 2007, the year before I got started in the stock market, 10% down. By the end of the year, up 5.5%. Then we had the big crash, '08. 48.8% down at the lows. The market finished total return negative 37%. 2009, the drawdown was intense, 27.6%. But the total return by the end of the year was plus 26.5%. 26.5%. So '09, people think about, the market was in such a big crash. '07, '09, it was the great financial crisis, so bad. Oh, really? 2 of the years were positive. And if you add up those ones together, if you add up '07 and '09 together, it basically just about cancels out '08. Isn't that crazy? Oh, it's not as scary as you think. 2010, drawdown was 16%. Total returns by the end of the year plus 15%. 2011, drawdown 19.4%. By the end of the year, plus 2% total return. 2012, about 10% down drawdown. By the end of the year, plus 16%. 2013, 5.8% drawdown. By the end of the year, 32.4% total return. 2014, negative 7%. By the end of the year, plus 13%. 2015, negative 12% drawdown. By the end of the year, positive total return, 1.4%. 2016, negative 10%. By the end of the year, plus 12% total return. 2017, negative 2.8% drawdown. And by the end of the year, plus almost 22% total return. 2018, it was not fun at the end of 2018, man. I was getting tore up in that market at the end of the year. The drawdown ended up being right around 20% in the S&P 500. It was vicious. But you know what the total return ended up being for the full year? Only negative 4%. Only negative 4%. 2019, negative 7% roughly drawdown. And by the end of the year, total return plus 31%. 2020, 34% drawdown. Vicious. By the end of the year, total returns plus 18%. 2021, negative 5% drawdown. By the end of the year, 28.7% total return. 2022 was a pretty vicious year, right? 25.4% drawdown, but by the end of the year, you were down 18% total return. 2023, negative 10%, plus 26% by the end of the year. 2024, negative 8%, plus 25% by the end of the year. And so far, we've had a little over a 10% drawdown in 22 and 25, right? And who knows where the total return ends up being by this year, by the end of the year. So the moral of this story, you look at that and you realize the stock market's not scary. And if you want to really make money in this game, do you know what you do? I'll tell you exactly what you do, and then we'll get into stock talk, and then I'll react to that video. Here's what you do. You buy the whole correction or crash you go through. You buy the whole dang thing. As it goes down, as it troughs, and as it goes back up. You buy the whole way. The only ones that get fooled and suckered in the end are the people that think they can try to time this out and get in the market and out of the market. I'm going to time it at the bottom. No one ever knows where the bottom is. In 2022, when the market bottomed around October, November of 2022, almost no one thought that was the bottom. Everybody was talking about we're going lower. We're going to be much lower in 2023. Big recession. It's going to be ugly. This is just a short-term little bump. We're going right back down, and it's going to be way more vicious. Basically, everybody was saying that. And what ended up happening? The market bottomed. In 2020, when the market bottomed toward the end of March of 2020, no one thought that was a bottom. Everybody thought we're going lower. Like businesses are going to be closed for a long time. We're going lower here. Market bottom, moved up. People said, no, fake out rally, like we're going lower. Never went lower, right? And you go back to the great financial crisis, they were saying the same exact thing. No one thought the market was actually bottoming in March of 2009. People thought, no, we're going lower. It's going to be a lot worse than this. Market bottomed. We started moving up. People said a fake out rally, and we never saw those prices again. This is what happens. Whenever you're in a correction or crash, people say it's not the end. We got further to go, further to go, further to go, and they're wrong. And so you buy the whole correction, you buy the whole crash, and then whenever you actually bottom for real, you continue to buy stocks. And you continue to buy them when the market moves up again. That's how you don't get suckered in this game. No one's ever been a sucker in the history of the stock market who was buying throughout a correction or crash in the stock market and coming out of it. Not a person in history. Great Depression, the 70s, the 80s, in the NASDAQ tech bubble. Heck, if you were buying the NASDAQ tech bubble at the peak of the market and then you bought it the whole crash and you bought it coming out, you still were a freaking genius. Think about that for a moment. Let that sink in. If you were buying the tech bubble at the peak of the market and you bought that whole crash down over those next couple of years and whole ride back up, people will look at you today as a genius. You're so smart. But people were made fun of back then. What? You're buying the NASDAQ? You're buying tech stocks? You're buying Amazon? What? Right? And over those coming years, when Google went IPO, people said, don't touch those stocks. Those are crazy companies. We don't know about these business models. The whole way. The great financial crisis. You could have bought at the peak right before the great financial crisis. Oh my gosh. About to lose the whole banking system. You had no clue. Boom. You're buying a market peak in 2007. Market crashes. You're buying the whole way down throughout the market crash, the bottoming, and the comeback. You were a freaking genius. And you bought the market peak of 07. As long as you bought the whole correction crash we went through, you're a genius. 2018, same thing. 2020, same thing. 2022, same thing. You understand now? The only dumbos are the ones that don't buy the corrections and crashes. That say, no, I'm not doing this. They always end up broke. And the ones that buy the whole dip always end up a few years later looking back very, very well. Never mind 10, 20 years later. Think back to if you could buy stocks in the market back in the great financial crisis. Would you do it? Of course you would. Everybody would. Would you buy stocks back when we were going through the tech bubble crash? Of course you would. Everybody would. Look back to what the NASDAQ was back then. Look back to what those companies were valued at back then, right? Look back to the great financial crisis. Yes, you would gladly buy prices. Look back to the 2020 crash. Look back to the 80s. Would you wanted to buy stocks during the 1980s crash we saw? Of course you would. Yes, please, thank you, because you would have made so much money it'd be ridiculous. So every crash and correction is just something to be very thankful for. You buy the whole dip and you buy it the whole way back up as it comes back. Because many times you're not going to see those prices ever again. Well, the prices we saw in the 08, 09 great financial crash, we never saw those prices again. The prices you saw in the 2020 crash, we never saw those prices again. That happens every time. The crash happened in 1987. We never saw those prices again. And I could take you through every crash ever. The tech bubble crash, guess what? We never saw those prices again. The NASDAQ went down to just over 1,000. We never, ever saw that again. Even when the great financial crisis happened, we didn't see those sorts of prices again. Never saw it again. So the moral of the story is, when you get those opportunities, like you pounce on those opportunities, right? You can look back at Amazon stock. Even in the great financial crisis, you never got Amazon stock at the price you got it at in the tech bubble. So you think like, oh, maybe I'll be able to get it again, not in great companies. Nope. Tech bubble here on Amazing's on, right? Massive crash. Amazon stock crashed 90% in that tech bubble because it's trading at just ridiculous valuations at that back then, right? And by the way, people were right about the future of Amazon. So let me be very clear about that. People that were betting on the stock back in 1998, 1999, they were right about Amazon. Like it was going to become this huge business. And so they were right and they were wrong. They were just paying ridiculous valuations for it. They saw the future in terms of like understanding like Amazon's going to be this massive thing, but they just were paying ridiculous valuations, which sets you up for a lot of risk over the next few years, right? And they certainly saw that risk when the stock moved down 90%, right? But then you got the stock all the way down to, on a split adjusted basis here, of around 29 cents. So where did the stock get in the great financial crisis, that is, right? In the great financial crisis, here's where the bottom is for Amazon. You're at 215. So basically, from the tech bubble crash to even the lows of the great financial crisis, the stock is still 10x'd. And so you got to understand, when you're going through these crashes, you're never going to see those prices again. Like, that's not how it works. You just aren't going to see it again. And so you've got to take advantage of the whole correction, the whole crash. You buy the whole thing down and right back up. And that's why I tell you guys always, the number one most important thing in the stock market is what? It's more income than expenses. As long as you got that, you're ready to buy stocks every 2 weeks, at least once a month. Sweet. That means you can buy the whole correction down, the whole crash down, whatever you're going through, and you can buy it the whole way back up. As long as you got more income than expenses, it's all that matters. You're ready to buy every week, every other week, every month. Boom. Let's go, baby. Okay? That's the game. Alrighty. Next up here, look at some of the damage out there, and then we're going to react to that really good video there. Retail trader investor stocks continue to get hammered. This app-loving company continues to just plummet, man. We pull up a lot of these stocks and kind of like, oh gosh, it's been nasty past month for these. AppLovin down 44% in the past month. Him stock down 45% in the past month. Tesla down 36.5% in the past month. Hood's down 36% in the past month. MicroStrategy down about 15% in the past month. Palantir is bringing tears, down about 31% in the past month, and Coinbase down about 32%. Palantir, by the way, is another good example of an Amazon-type company in terms of, people were bidding the stock up recently to 125 or so, and those people might be right long term in regards to Palantir, right? But it sets you up for a lot of risk over the next few years when you're paying, a 200, 300 forward P and those sorts of prices, right? Big tech definitely getting hit a bit today. I'm bullish on most of big tech actually for this year. Don't be surprised if many of these big tech companies end up finishing, let's call it, a lot higher than where they're at right now by the end of the year. Don't be surprised at all. I'm actually bullish on big tech for the remainder of the year. If we look at housing stocks here, housing stocks getting hit pretty hard again here today. Enphase getting hit, RH getting hit. Whirlpool, some of those sorts of companies might eventually be in my buy radar. Not quite yet, though. They might eventually get there, though. My possible buys watch list here. So Elf, oh man, that one's tasty there. Trade Desk, I'm still doing work on Trade Desk, so I still got more work to do. That one's a potential buy at some point in time, but still doing more work there. SoFi looks like a snack. Alt actually looks decent here as well. Texas Roadhouse getting hit. Texas Roadhouse was down a lot more earlier in the trading day. Cake's looking good here. Lulu's a potential buy for me. I don't know if I'll actually buy it. I already have so much invested in Nike over this next few years. I don't know if I want a Lulu as well. We'll see what transpires in regards to that.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
Okay, let's address the elephant in the room. Losing $500,000 in the public account, just like that. Well, here's my perspectives on that, right? If we go back 2 years ago, the public account was around $1.2 million, okay? If we go back a year ago, right around this time a year ago, the public account was around $2.1 million range, okay? As of today, oh, fancy. Ooh, sounds good. That car sounded good. That lime green special right there. As of right now, the public count's just under $2.8 million, right? So we could say lost 500,000, or we could say gained, 1.6 million. Like, you know what I mean? Like, we could say a lot of different things in regards to this. The moral of the story is the count is trending higher and higher and higher and higher and higher, right? As the years tick on here. And this is a portfolio that's probably maybe 8 years old now at this point in time, somewhere around there. And we built it to now almost $2.8 million portfolio. If I look out 8 years from now, I think this portfolio is probably going to be, easily $5 million portfolio 8 years from now, but probably closer to $10 or $15 million if we look out 8 years from now. So it says 2.7, 2.8 million right now, and I'm thinking 8 years from now, I'm thinking like this is like a 10 or 15, $20 million portfolio. So whatever the short-term stuff is in regards to the market, it's here today, gone tomorrow. Tariffs, taxes, Doge, blah, 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 blah. It's all here today, gone tomorrow. The moral of the story is great companies continue to do great things, and they appreciate over time. So where I like to really focus my attention in time is really around returns of the portfolio over time, right? And so if I pull up the 5-year returns for the public count, this is calculated by Fidelity Investments. The 5-year cumulative pre-tax return for the public count is 341%. That's versus S&P 500 at 142%, and that's versus the Dow U.S. Total Stock Market Index at 138%, right? So we're doing very well. We're doing very, very well if you compare us against the indexes, right? Additionally, once the 10-year returns hit, I think they're going to be even more dramatic than what you're seeing in front of you. And that's already pretty insane outperformance there, right? So that's what I really like to focus on. Am I destroying the market over a 5-year span? Good. And then once this portfolio has 10-year returns, we'll put up the 10-year returns calculated by Fidelity, and it's going to be pretty extraordinary as well. So all the other short-term, how a portfolio fluctuates in 1 week or another week, it means nothing to me. And keep in mind, someday when this portfolio is $10 million, you're going to see fluctuations of $1 to $2 million on a regular basis. So I will lose $1 million just off a 10% correction in the portfolio. Right? If we get a 20% downdraft on a $10 million portfolio, that's $2 million lost, right? So just keep in mind, the numbers are just going to get bigger and bigger and bigger as the portfolio gets bigger. Someday, if I want to keep running this portfolio long term, probably be a $25 million portfolio, $50 million portfolio, right? And then a 10% on a $50 million portfolio is now $5 million. Oh my gosh, I just lost $5 million, right? 20% move, we're talking about $10 million then. So that's just like the cost of doing business. The portfolio amounts get bigger. Now, I also want to push back against this asset allocation here because, Fidelity gives you this asset allocation here, and they say your asset allocation resembles a most aggressive strategy, right? And I want to push back against that. I want to say, is a public account really the most aggressive strategy, right? Let's think about this. Let me push back against this for a moment. Okay, so Meta, arguably the greatest business model in the creation of mankind, right? A service in which 3 billion plus people use their services, right? A diversified between Facebook, Instagram, WhatsApp, the VR future, the AI future, one of the strongest income statement, balance sheets, cash flows you will ever see in your life, right? And a very fair valuation. So I just have a lot of trouble calling that a most aggressive strategy, investing into Meta stock, okay? My second biggest position in the public account is a company named Amazon. A company that if you look out decades from now, they're still growing. The e-commerce business is not going to stop growing anytime soon for decades, right? Like if we look at decade after decade after decade, like that business is going to grow for 50, 100 years in the future. AWS is a backbone of business, right? That's not going to be disrupted anytime soon. And then you think about their advertising platforms just continue to get bigger, and that revenue just continues to go up. And once again, it's just another company that throws off incredible amounts of cash flows, and their cash flow story is still early days. We got a long way to go here in regards to Amazon cash flow story. I mean, can you imagine Amazon's cash flows 5 years from now, 10 years from now, 15 years from now, right? I just have trouble thinking like Amazon's the most aggressive investing strategy. PayPal, AMD, Tesla, you could say, okay, that's maybe aggressive, right? 6%, okay. We'll talk about Tesla in just a moment. Palantir, you can say, okay, 6% of the portfolio, that might be aggressive because Palantir obviously trades at a very rich valuation, but they also have extraordinary growth rates, and they also are another company that's set up for, like, when does Palantir stop growing, right? I don't know. 10, 20, 30 years from now, I think someday Palantir will stop growing as a company, but it's so long from now, right? Their growth rates are probably going to be extremely high for the next several years. So, I mean, yeah, someday Palantir is going to stop growing. So the only way you could push back against Palantir being aggressive is just like the valuation, right? Nike, come on, man. Nike's been around here for decades and decades, and every decade they remain to be more relevant than the previous decade, and they continue to do that. Cake, I mean, as solid comes with another company with 10, 20 years of growth in front of it between their multiple different concepts, right? Celsius, it's just a very stable business. I mean, at the end of the day, it's energy drinks. Recessions happen, inflation happen, all that stuff. People are still going to drink their energy drinks. That's just a bottom line with that, right? And so that's another company that's still very early days in regards to their revenue story and their profitability story. Estee Lauder's been around for many, many decades and has an extremely successful business and is trading at among the cheapest market cap it's traded at in many years. I think they're looking good. Elf is a company that's resilient in any environment. It doesn't matter. Tariffs, inflation, it doesn't matter. Elf puts up numbers, right? Fubo, you can say, okay, that's an aggressive stock there, but it's 2% of the portfolio. So Revolve, one of the best income statement balance sheets you'll ever find from a small cap company. 2% of the weighting, I just don't find that being an aggressive stock. Honest sells diapers, lotions, soaps, shampoos, makeup. Not and now the company's got a war chest of cash piled to the sky, and they're getting a profitability. I just don't find that one very risky. SoFi, okay, you can say maybe that one's a little risky because they're banking, fintech, and you can say maybe Planet, but those are extremely small positions in relation to the portfolio. But you look at many of the companies I own, they're the strongest, greatest companies in honestly the world that you would want to invest in. And that's where I have my big dog money. So the fact that Fidelity says this asset allocation resembles a most aggressive strategy, not in my eyes, but hey, to each its own, whatever they want to say.